panel discussion for the day, which is the AAA Masterclass, Alpha Generation over the long term. We're going to be joined by our moderator first, Mr. Nimesh Mehta, the Director and Country Head, Business Development and Products of ASK Investment Managers. He is also responsible for the offshore sales through the distribution network. He is a commerce graduate, MBA, and certified financial planner, and has over 20 years of experience in the field. He has also authored the book Sales Booster. He is going to be our moderator for this session. Thank you so much, Mr. Nimesh, for joining us today. It's been our pleasure. And on that note, I am also going to be introducing quickly our panelists who are going to be joining us for this discussion. Up first, Mr. Sunil Singhania, the founder of Abakkus Asset Managers. Mr. Sunil Singhania, CFA, is the founder of Abakkus Asset Managers. He is graduated in commerce from the Bombay University and completed his chartered accountancy from the ICAI, Delhi, with an All India rank. He has also earned the right to use the Chartered Financial Analyst designation conferred by the CFA Institute. Thank you so much, Mr. Sunil, for taking time off from your busy schedule and joining us today virtually. Thank you so much. And our second speaker for this panel discussion is Mr. Kenneth, founder and CIO of the Old Bridge Capital. Mr. Kenneth manages the investment process and leads investment ideation at Old Bridge Capital. Along with over 30 years of experience in the Indian capital markets, portfolio management, and investment research, he has a formidable 15-year track record managing some of India's most successful equity funds. Mr. Kenneth, thank you so much for joining us today.
Thank you.
And last but not the least, joining us as our third speaker on this panel is Mr. Dinshaw Irani, Chief Investment Officer of Helios Capital India. So the Chief Investment Officer of Helios India. Prior to this, he was the Executive Director at Artemis Advisors for over 14 years. Mr. Dinshaw is a graduate in Commerce Honorable and holds a postgraduate diploma in rural management from the Institute of Rural Management. Mr. Anand Dinshaw has total of investing experience close to 28 years. So thank you so much, our esteemed guests, for joining us today and being part of this virtual summit. I know that things, when they go virtual, there's a lot more complications involved, but keeping all of that aside, this is a great platform for us to interact and be safe at the same time. So over to Mr. Nimesh, who will be moderating the session. Thank you for joining us today.
Gentlemen, welcome to the panel discussion. Let me begin by congratulating Daniel, Pallav, Hamid, and the entire PMSBazaar team for hosting the third PMS and AIF summit and their first virtual one. We wish them the very best success for the entire summit. Now, we have been given a very interesting subject for our panel, that is Alpha Generation over the long term. And it's my pleasure to moderate this esteemed panel of speakers who individually bring close to about 30 years of investment experience. So not only we have a collective wisdom of 75 to 80 years, but we also have experts on this panel who have investment experience across mutual fund, AIF, and PMS. So let us jump into the discussion straight away by asking my first question to Sunil. Sunil, if I'm right, you started a career in 1994 and Nifty then was about 1,000 points. Today is close to 13,000. And I still remember that article, which was when you were in Reliance Mutual Fund, when it said that your Reliance Growth Fund had done 10x of what the Nifty had done. I've seen, and having done such amount of, sorry, there's some disturbance, outperformance, I'd like to ask, what are your top 3 learnings or success mantras in generating alpha over the long term? What is Sunil?
Thanks for having me here, team PMS and AIF, and thanks Nimesh for the kind introduction. See, I think, one thing is very clear. Equity investors have to be optimists. If you are a little bit apprehensive about the future, you should not be equity investors. Second is, when you are investing in India, India is not a mature economy. India is a growing economy and a fast growing economy. So you have to be very clear about that. And third is, India is a country of entrepreneurs. I always say this, that India grows because of entrepreneurship and despite the government. And when you have this in mind, I think if you are a long-term investor, you have got my answers. You have to first be positive. You have to believe that India is going to grow fast. And third is, if you invest in the broader markets, that is where, alpha is going to be made. The only one thing I would like to add here is that the world has become very dynamic. So even in the last 25 years, since 94, 95, which you mentioned, till now, earlier this 3 Sigma, 4 Sigma, 6 Sigma events used to happen once in maybe 10 years, 20 years. Nowadays, every 2-3 years, you have this 6 Sigma events happening. And that means that the patience which an investor needs has gone up manifold. Earlier a drawdown of 10% was digestible, a drawdown of 20-25% was scary. Nowadays, a 25-30% drawdown happens almost every year. So to that extent, the investor has to be a little bit more patient than they were earlier.
I completely get that. Let me get Kenneth here. Kenneth, you have delivered a high double-digit compounding returns for the almost last 2 decades. I remember IDFC Premier Equity under your tenure had done a CAGR of 22.3% for a long 10 years. And so, as a viewer, we want to ask, can we look at the similar outperformance over the next 1 or 2 decades? And how would your investment approach be in the next 1 decade?
Well, someone out there is going to do it. The environment was very much different from 2005, 2015. Information flows today and arbitrages between segments of the market are quite more democratic currently. So yes, I think performances vis-a-vis the broader indices will come down. Okay, but none the same, I think there are pockets of opportunity which are there. It will happen again, but it will happen over point to point in the indices or in the economy.
Yeah.
It can be done. I think one way of actually doing it is to make sure that you're not competing with the index, because it's just a benchmark that exists out there. And as long as you have active portfolios, which in my experience has been the case over the last 2 decades, if you had very active portfolios, they very comfortably beat benchmarks over a long term. So yeah, it can be done. It will be done by somebody. Hopefully, I will be one of them who can do it over the period of time.
Could you throw some light on investment approach? How would you approach that? It will be good to hear the investment approach you'll follow to generate alpha.
So I left a couple of points there. I mean, you have to be an active investor out there. And if I just look at the cycle or look at our investment approach that has brought us this far, we basically like to concentrate our risks in some segments of the market. And if you go back into history, segments of the market usually polarize themselves and create bubbles. So at all points in time, the market does end up being a bubble. Okay, go back to 2000. If you were with tech, you probably didn't do too much in the marketplace. 2007, it was all investment. It was all about investments, the capital goods and commodities. We're just coming out, or we're close to a significant growth in consumer spending that's on the ground. Now, our sense is that if we can identify these trends very early into the cycle, then obviously you get valuations in your favor, and you get back-ended growth. But first, valuations have been there, and then you have back-ended growth that comes in, and that's something that delivers return over a long period of time. That's been our approach to putting portfolios together in this cycle.
Sure, Kenneth. Let me bring you in. We all know Helios Capital for quite some time, and it was a pleasure to see Helios launch its first PMS business in India, I think in March 2020, if I'm right. Our viewers will not be familiar with your India offerings. So, can you take us through your briefly on your PMS offerings and investment philosophy, please?
Sure, Nimesh. Thank you for having me on the show, and thank you to the viewers for listening to us. Okay, so let me start off with the offering. Actually, we have a license for both the PMS and AIF both, but we chose to go with the PMS in March itself because we thought of approaching the masses, go to the masses, and frankly, the kind of transparency a PMS brings, AIF doesn't. The investor can see the portfolio on a day-to-day basis. Yeah, that was one reason. Secondly, the point is that we have a 25-year investment history. I mean, one of the principal shareholders of our company is Mr. Adrade, who's been investing since 95. So we have a 25-year history in investing, and our philosophy has evolved over 25 years. So what we've used here is what we've learned over 25 years, basically that to have a bottom-up approach on a stock, it works best when the stock or the industry is having massive tailwinds, as we call it. Get the big picture right. Once you get that right, there's a momentum which will continue for the next decade or two. Yeah. So that's why, and how to identify these tailwinds? I mean, that's a classic question also. So what we did was we started developing these themes, investment themes along the way. And we said, okay, let's identify these themes which will throw up these industries, which will give you these industries which will have these tailwinds along. Yeah. So the first theme that we came across, and we used that in Alliance days also. So at that point in time, I used to be with Samir in Alliance. I worked with him from 2000 till 2003. So what we developed then was, which we called as compete with the government. Here we identified stocks which are competing with government companies. Mainly the industries which come up here are private banking, infrastructure, education, healthcare, and so on. Yeah. The second theme that we developed was demographic and lifestyle changes. Mind you, all these themes are very intrinsic to India, very unique to India. Yeah. Again, when you talk about demographics, one of the youngest populations in the country, I mean, in the world, is in India today. Yeah. And these are all aggressive consumers. They don't mind taking loans at young age or spending on the credit cards and all. So basically, the industries that came here were under-penetrated consumer stories, more metro-centric than rural-centric as such. Be it consumer financing like mortgages or credit cards, or media companies, or aviation, and so on. Yeah. The third theme that we identified was factor cost advantage that India had to offer. Basically, export-oriented units like IT, ITES, pharma, or chemical exports, and so on. Yeah. Now, once you identify these themes, we started with a universe of 500 stocks. Yeah, the Nifty 500, if you will. And we started applying this theme to those 500 stocks. We were left with somewhere around 270 stocks. Still too difficult to do a pure bottom-up research on 270 stocks. Yeah. So we said, okay, now let's go and start applying what we call as look for negatives in these stocks. By the way, so there's nothing, positives there's no end to positives. Yeah. But negatives, there's definitely an end to it. You have to find out one negative for a stock to convince you not to buy that stock. Okay, that's the philosophy that we follow. So a classic example here is if a promoter steals money from the company, it's a bad company. You don't buy that company, right? But if he doesn't steal the money, doesn't mean that he's a good promoter. He's doing what is supposed to be done. Yeah. So that one negative is enough for us to reject the name. Yeah. So we developed these 7 parameters on which we started finding out negatives. The first parameter was industry dynamics. How far is the tailwind? What are the disruptions that is possible within, and so on. Yeah. The second thing was potential for disruption, which was mainly for technological reasons and product reasons, which came in if there was any potential there. The third was management history. I mean, what has been his growth discipline, what has been the capital allocation discipline by the management, and so on. Yeah. The third one is corporate governance. Fourth one is corporate governance, which again is about insider trading, or for that matter, warrants being issued at some discounted prices, and so on. There are lots of parameters here. Yeah, I'm just naming a few. And the fifth one is financial analysis. After you've relegated on all these, you come to financial analysis. And within this, we look at the balance sheet more than the P&L, because we believe all the landmines, and I'm sure my colleagues on the panel would agree, lie in the balance sheet. They don't lie in the P&L, they lie in the balance sheet. So you got to be very careful of what you're looking for and try to tally it with what is there in the P&L with the balance sheet as such. Yeah. So that's on financial analysis, and then comes valuation, and lastly comes medium-term triggers that we look for to go in and out of this. After you've done all this, we come to around 150 odd names, which are investable universe. Then you do a rigorous bottom-up approach on those, come to around 60 odd stocks, which can go into the portfolio. But ultimately, you look at the last 2 parameters of valuation and medium-term triggers and decide which 30, 35 want to move into your stocks. So that's in short how we select our portfolio. It's a diversified portfolio. It's a long-only multi-cap diversified portfolio.
So thanks so much, and we wish you the best in this
Thank
PMS
you.
journey. Let me bring Sunil again. Sunil, I'm sure you're meeting a lot of investors. I do face a lot of Indian investors today feel have a left out feeling, okay, because the run up has been too fast in the last couple of months. What is your advice to those investors, and what will be your investment strategy in current times?
So, having been in this market for the last so many years, I think all of us know that this is an oft-repeated story. When the time for investment is the most appropriate, the eagerness or the mindset of all of us, investor, private bankers, us, is also not that great, and vice versa. Having said that, I think we have to remember a few things, Nimesh. And being one of the largest private bankers, I am very sure you interact with investors more than we do. But in my journey as an entrepreneur, last 2.5 years, even in Reliance, I used to meet people, but it was predominantly the intermediaries I used to meet.
Yes.
Direct investors were not that many which I used to meet. And in this journey at Abakkus, I meet a lot of family offices. What has shocked me is, one, the number of family offices who are really wealthy, and second is the amount of wealth with each of these family offices have.
Absolutely.
And I think increasingly what is even more shocking is that their exposure to, I would say, equity other than their own businesses is absolutely low. And earlier, you could argue that fixed income was making me 8-9%, and commercial real estate was giving me 6-7% yield. But both of them are not there now. So fixed income has gone down to like maybe 5-6%, and on top of it, Government of India is your partner to the extent of 30-40%. So you're left with hardly any returns. Commercial real estate is now a question mark because of this work from home, and the adoption or the absorption of commercial real estate this year has definitely been like less than 50% of last year. So that is a question mark. And I think then you come to equity markets. Yes, we have seen a stellar run. And I would say all of us would be lying if we said that we expected this to happen. We expected the markets to bounce back, but not to the extent which it has. But I would say that even the fundamental triggers have been much better than what each one of us expected. And in India, there are multiple reasons for it. One is the interest rates fall. It has been in line with the global interest rates, but for once, interest rate or the low interest rates are now being passed on. So you have mortgage loans below 7%, which means your per month EMI is down by almost 30%. On top of it, you have discounts as far as the developer is concerned, some stamp duty relaxation, and you have that. You have saved on a lot of costs. We are having a virtual conference. If we had an in-person conference, each one of us would have spent 300-400 rupees on petrol to reach the venue, besides spending another 2 hours in getting in and getting out. And we started on time. No conference which is held in person starts on time. Today we started at bang on time. And then we also have a scenario where China is the villain of the world, and particularly of India. So you have a lot of import duties, countervailing duties, which might not be the best way from a longer term perspective, but near term, the profitability of companies has gone up. I think we have lower taxes, income taxes for corporates. That has pumped up earnings. Much lower taxes if it's a new manufacturing unit, and along with this PLI incentives, some businesses will suddenly see 50% rise in their EBITDA. So I think as we speak, we are not cheap. Maybe we are on an FY23 basis 16.5 times. These estimates keep on changing. Luckily, for the first time after September numbers, the estimates are being upgraded rather than downgraded. I think in the last 7-8 years, we have not seen that. And in that kind of a scenario, even if you're able to generate 9-10% return from a large cap investing, I think the investors should be very happy, because on a post-tax basis, it would be 2 times, 3 times the fixed income returns. And if you go a little bit deeper on the broader market, maybe from a 3-4 years perspective, this would be the only asset class which can give you maybe 13, 14, 15% return. So I don't know what is going to happen tomorrow. I don't think the markets are going to crash. And my view or my advice to the investors is that be prepared for a 5-7% drawdown at any point of time, and be modest in your expectations. If you are looking at lower double-digit returns, you will not be disappointed.
Great answer. Let me put that same question differently for Kenneth. Can the investors who are inside the market now have the urge to book profits because they feel the run-up has happened too fast now? Now, what is your advice to those investors, and what will be your investment strategy in these times?
Well, Sunil's articulated it pretty well. Okay.
I agree.
What are your alternatives to where you could put your capital to work at this point in time, and what's going to come out at the other side? So I've got very little to add, and we've been all around in the equity markets for an extremely long period of time. Yes, and we've seen double-digit returns coming in quite consistently. It is also fairly favorable as far as taxation is concerned, as far as the equity classes there. So whether investors do it now or they do it later, I think finally investors do come back to equities at the end of the cycle. So, like any other process, I think we should, or most investors should follow obviously an asset allocation, keep money available for a drawdown, and for and change this change the attitude of of selling on the down cycle. I think a lot of investors take money out now, or they have taken money out where returns are extremely low. You have to necessarily take money off the table. Taking money off the table is a good thing, but take money off the table when it starts when the underlying asset class is making money. I think that's where we should be today. What we see with the marketplace is a lot of investors have seen the market come back. Returns are still in their low. I would say mid single digits or high single digits, and uh, my sense is, and our sense has been that once those numbers turn extremely attractive, that's when money should actually leave the cycle and not come into the cycle. I think all investors need to reverse what they have been doing in the past, and it will be a profitable journey.
I appreciate your honesty in the answer. Let me bring Dinshaw here. In the similarly current times, we are hearing of a second coronavirus wave, and we are seeing markets at an all-time high. So, what will be your advice to the investors, and what will be your investment strategy at this point in time?
So what we tell our investors is very simple. Don't look at the March lows. In fact, that's what I wanted to, when Sunil was answering, I wanted to interrupt and tell him that, put in these words. Don't look at the March lows and decide how the market has run up. Look at your year-to-date returns of the market. They're up some 6% yeah. Now look at the fundamentals. What has happened? Probably the fall was savage, yeah, but it wasn't justified because ultimately the earnings drop that one saw in the March quarter wasn't as much, and in fact the June quarter surprised on the positive side in the sense no analysts realized that the companies had so much potential of saving costs. The kind of cost cuts that they undertook, they ensured that the fall in profit wasn't as much as that of the top line that they saw. Yeah, and then came the September quarter, which was eye opener for all. Massive upgrades. Yeah, in fact, some of the houses had 4:1 kind of upgrades, and as a result, the Nifty also earnings started getting upgraded. And today, the Nifty growth is almost flat to around mid single digits up as compared to what where it started the year at. Yeah. So all in all, I don't think unless there's a massive lockdown, which I don't think is going to happen. I think most of the countries have, I mean, rather India has learned it the hard way that you can't do a one-shot lockdown for a month and then assume that things don't rebound back. I think we're living with it. Round the corner is the vaccine, which hopefully will come through. So I don't see any scene of panic. In fact, if you go into 22, the earnings growth is supposed to be a massive 30% plus, but it's not comparable. But still, I mean, that's kind of the earning growth which has never been seen in Nifty earlier. So I think it's better to stick around. That's what we tell our investors. Say, look at the fundamentals and trust us with your money. So,
fair, absolutely fair. Let me again get in Sunil here, and let's get to the subject, which is what the PMSBazaar wants to tell the investors. Alpha over the long term. So let me ask the question to Sunil. Sunil, the current market rally has been polarized with very few stocks and done exceptionally well. Now, do you think that there will be a broad-based participation in the market? Which sectors do you think will lead to that alpha in the medium to long term?
Okay, so I think you are right to say that the rally began with a few stocks, But as we have moved forward, I think the broad markets have definitely participated.
Caught up.
So, I wrote a note last year, which was bubble in quality, and I still believe in that. I think there were a few stocks because of the perception that these were great companies. People were investing in them without heeding to their valuations. And particularly, if a company is growing at 10, 11%, I don't find any justification of giving it 70, 80p. It's not worked in 300, 400 year history of investing for a sustainable period of time anywhere in the world. And I am very confident it is not going to work in India. At the same time, because there was a general apathy and, the broader markets, the mid caps and small caps had become a bad word post the fall in 1819, those companies were just available at very attractive levels. And we are talking about good companies. It's not that only the large companies are good. Even some of the mid-size and small companies have great management, great moat, and great business models. And ultimately, the Bajaj Finance and Eicher Motors and so many other companies have graduated from being a small cap to a large cap in as short a period as 10 years. So our view is that this rally has become broad-based, and the money is going to be made, or the alpha is going to be made by proper disciplined investing rather than perception investing or herd investing. And sometimes you end up investing not because you are confident of making money, because you don't want to be left out. And there is a fear that, if I don't buy this stock and this stock moves up, I will be left behind, or this stock is a big component of the index and therefore I have to buy. Now, when you come to your question about, where alpha is going to be made, as I said, there are stocks which are going to be big beneficiaries. One, of renewed demand. Second is also of lower interest cost. Third is, though fossil fuels have seen some rise in prices, but structurally they are weak. And India is one of the countries where power cost is one of the highest in the world. And if you actually dissect the September quarter numbers, for a flat top line, the margins at the EBITDA level have gone up because power costs have gone down. And at the PBT level, the profit growth is higher because interest costs have gone down. And the full impact of this interest cost going down is still to be felt. And the other thing would be with lower interest cost, I would say that even demand will go up, whether it is passenger vehicles or houses. So my view is that, unlike earlier when we were clamoring to go into debt-free companies, I would rather be investing in companies which have manageable debt. I'm not saying 100% of your portfolio should be in those companies, but companies which have manageable debt, because someone in India will have to make cement and steel and aluminum and copper. Everyone cannot be a debt-free consumer company, Everyone starts to consume. Who's going to make all the machines and all the other bridges and the steel and everything of the world? So we are basically looking more from a diversified angle. We still like, places where Dinshaw mentioned, where India has a moat in terms of expertise, like IT or pharma. Select chemicals or chemicals right now is trading at a higher valuation than even pharma, which I can't understand. At the same time, there are some domestic plays which will benefit, and we are not averse to investing in that. One thing which we have to not forget is that we have to change our investing stance a little bit. The way we are working, the way we are studying, the way we are consuming, the way we are entertaining, and the way we are doing every other business is changed. And therefore, this digital part of the economy is something which we cannot afford to ignore. Stocks might look a little expensive now. People don't try to understand them, including us. Though aankh hamari khul gayi abhi, so we have started to try and understand them. But suddenly these companies can just go berserk. Now, who would have imagined Byju's to be a $15 billion company? There is no education company in India which has reached even $100 million of market cap on the listed space. And this is a company which is $15 billion market cap. Unfortunately, a lot of these companies are on the unlisted space. But whenever you get an opportunity, either directly or indirectly, to buy some of these companies on the listed space, you just can't afford not to invest in it. So this would be, I would say, a very short thing. Otherwise, the question is such that I can have individual session with
30
you for
minutes.
3 hours.
I know that. I know that for keeping it short and keeping it sharp for our viewers. Really appreciate that. Let me ask.
I, I just I
Yeah,
just want to
yeah.
add one more thing. Sunil, we just have one chemical company in our portfolio. We also are very aware that these are expensive stocks. So that though we have it in the list, but there's only one.
Okay. Let me bring in Kenneth. Kenneth, this the same question differently. Which kind of market cap segments do you think will have a role to play in the alpha? Will you buy in a mid cap, small cap, large cap, market cap agnostic? Just your thoughts on which segment can lead to the alpha generation as we move forward.
I mean, in short, I think it's an opportunity for virtually every segment of capitalizations that are there on the ground. So I think a good portfolio will do well to invest across capitalizations and not just stick to one part of the capitalization. But going back to the past, small companies have become dramatically big. Okay, so whatever you see in the indices today all come from either the mid cap indices, have come from the mid cap indices or mid cap companies. So if you're looking for growth, you're looking for great entrepreneurship, and if you're looking for a category leadership, so find small categories, find companies that lead the lot, and they will come out right on top. So that's been our preference. Look for category leaders, small or big, preferably most of them do come from the mid cap space. And the, the decade, I mean, if you take 2030 from today, the indices will have a very different construct. And a lot of them will come from the mid caps.
Any thoughts from Sunil or Dinshaw on the market cap segment you would like to consider in the long-term alpha?
So I mean, alpha generation, I have my own views, yeah, because alpha
Sure.
generation, I believe, comes mainly from the construct of the portfolio, as Kenneth also pointed out to an extent. The point is you have to have a balance. You may have the best of stocks, but if you don't have a balanced portfolio or a diversified portfolio, you may end up, destroying alpha rather than generating alpha. And by way of balance, I mean, you may have a balance of by way of market caps, by way of industries, or by way of whatever you feel as you looking at balancing out of P's and valuations and so on and so forth. Yeah. The fact is that if you can develop that, that is what, and that's what we do actually. In fact, we have two buckets in which we put our stocks. I'm sorry, I'm just coming through with that.
No, please go ahead.
One bucket we call as high confidence and reasonable returns. Okay, that's the core part of my portfolio, where we have around 10 to 12 stocks, which will be roughly around 5% on an average kind of weight. So 60% of stocks are in this bucket, which we believe has re-rated itself. Okay, and from here on, it's mainly the earnings growth which will pull up the price of the stock. It'll work in sync with the earnings growth, and there'll be consistency. Again, going back to that tailwind that we talked about. Yeah, so we ensure that there's a tailwind which will pull that stock across. The second bucket that we look at, which really is the one which is, I won't say volatile, but provides the alpha, which is your reasonable confidence and high return. Why we call reasonable is because ultimately, what are you trying to do when you're investing? You're trying to predict the future, right? And future at the best is unpredictable. So you're taking a very studied bet, yeah. And when you do that, you try to. The best way to do a studied bet is when you diversify your portfolio. When you have a longish portfolio. That's why I said 30, 35 stocks, because around 10, 12 stocks come in my first bucket and around 20 odd stocks come in my second bucket, where the weight is around 1.5%, 2% or 2.5%. Because I'm not comfortable with those names. I have my future estimates in place, but I'm not too comfortable, and I'll wait for the stock to perform along with our thesis before going and investing more in that company. Yeah. So these are the two buckets where you keep playing around with. Yeah. And on the downside, that is when you really need to protect. Yeah. Because the drawdown, it's pure maths, right? If the market falls 20 and your portfolio falls 10, on the way up, you just have to run another 11%, while the market has to run 25%. Yeah. But when the market runs 25%, you will be at 112. So you'll beat in the market, hands down. Yeah. So that's how we look at our portfolio per se. And we believe it diversified is the best way to play it. Because with diversification, you can play around with market caps, you can play around with your names, you can play around with your alpha also. So
you prompted me to the next question, which I wanted to ask. And there's one set of investors which says that you should have concentration in your portfolio to do a long period alpha. And you mentioned and touched upon that about a 30-35 stock portfolio, which is reasonably diversified there. I mean, what are your thoughts? Dinshaw, since we're talking to you, maybe you start first, and then Sunil, and then maybe Kenneth, if you want to add on the diversification or a concentration to lead the alpha generation.
Yeah, so that's what I said. We believe that a diversified portfolio is the way going forward, because frankly, I mean, as I said, we bring you bring humility to investing. We don't believe that you can owe 12% of a stock or a 10% of a stock when the stock is a small company. Yeah, so you may end up missing out the whole run. If the stock is a large cap, maybe you're comfortable owning that. But the fact is that you missed out the whole run from a small cap to a mid cap to a large cap. Frankly, we are not into small caps also. We very wary of small caps. I would rather look at a stock in the mid cap segment and then try and play it out there. But the fact is that I will not have a 12% weight or a 10% weight in a stock which I'm not too comfortable with, or not knowing too much of history about the stock as such. And frankly, I mean, if you look at the diversified portfolios, others also, the concentration, maybe 10 stocks or 12 stocks, are all well-known stocks. But the fact is that they've left the run earlier. Yeah. For instance, we had a Bajaj Finance way back in 2008. But the point was that we had only 2% of Bajaj Finance at that point in time. And anyway, we never guessed that it will do so very well going forward. Even when you're talking about predicting the future, I remember buying an Aisha again in 2008, or was it 7 or 8? I think 7. When the story was Volvo. It wasn't about his RE. Yeah? It wasn't about Royal Enfield. The story was Volvo. So we went totally wrong on the story, but the stock performed because of Royal Enfield. So there's no way. We really believe that nobody knows anything about anything beyond a point. Yeah. After that, you're guessing the thing as such. And frankly, I mean, you may feel that concentrated portfolios, the track record is very good. But the point is that the one who's got us wrong has vanished from the market. He's not around. So that's why statistically you may just see the survivors and not the ones who have vanished from the market. That's
sure. Some thoughts, Sunil, your thoughts, if you want to add?
No, I more or less, agree with Dinshaw. Even, in my history, even at the mutual fund industry, and there the corpuses used to be larger. So we used to have a 50-60 stock portfolio. Here the corpuses, we try to restrict each fund to around 1,000-1,500 crores, and therefore we are comfortable with the 30 stock approach. So the way we do it, the top names end up having anywhere between 4 to 5% of the weightage, and the tail tends to be anywhere around 2% of the weight. And sometimes stocks from the tail move up because they do well, and stocks from the top move down because they are not doing well. So by and large, I think that is what we maintain. And the reason is not because we don't have high conviction in them. See, when you are managing money in mutual fund, you had millions of investors. In the AIF, we have like 400-500 investors, but it's a large number. And you don't want a scenario where one stock or two stocks drag down the performance the way they can increase the performance. If you are managing for a family office a concentrated portfolio, and when there is a one-on-one dialogue, you can explain to the investor what you are trying to do. There you can have a concentrated portfolio approach. So we have a PMS strategy where it's like a 5-stock portfolio. But that's for really, really large, very, very large family offices who understand equity markets and investing. But otherwise, for the broader, I would say, mass affluent segment, which is predominantly the PMS and AIF, I think there we would like to have a more diversified portfolio.
You set the platform for the last question, which I had for the gentlemen on the panel. Is there a difference in generating alpha in a mutual fund, AIF or PMS? Anyone wants to give it a shot? And why do you prefer a PMS or AIF? I mean, I completely get in terms of that each of those platforms has its own advantage. But if you were to just throw some thoughts on the AIF,
I can start a little bit, and Kenneth has also worked on the.
I want to start, but you can go.
Dinshaw, so we can all chip in. So one is, I think by nature we try to restrict the size of the fund, and particularly when you are trying to do broader markets, to some extent it helps. The other thing is, I think in the AIF segment, for example, we have a close-ended structure. and therefore you know this money is going to be there for a long time. Uh, there are mutual funds also which have a close-ended structure, and I am very sure you have the data which
Yeah.
shows that the close-ended in fact done worse than the open-ended ones. But at least I find that is a comfort. And I would say the other thing is that, somewhere down the line, when you have a large enterprise, gathering asset becomes your motive. And at least for us, after so many years in the industry, excelling is the motive, and asset gathering becomes an ancillary, I would say, mission.
Nicely said, Kenneth and Dinshaw.
Yeah, okay. Let me go here, Kenneth. Sorry.
Sure,
Uh,
sure.
Mutual funds are not here on this forum. I can very well say mutual funds are the last ones you should be looking at. Yeah. The fact is that the corpus are so huge, and the fact is again that the portfolio is too diversified. In fact, the tail is so long, and in fact, the head also is not that big. So the concentration they can't buy with conviction per se. So that's one area which is out. Secondly, as Sunil rightly pointed out, AIFs come with a lock-in structure. So, but our belief was that when we, in fact, that's what I started off the whole discussion with, was that we chose PMS over AIF basically because we realized that with a lock-in structure, one tends to become a bit lazy in selecting stocks, and it's not that transparent also in a way that you can buy and your money is for a longer term. But when it comes to a PMS, you will, every day your investor looks at you, every day he can see the changes in his portfolio, every day he can track every single movement that you've done in the stock. So you have to be active on your feet for that. And that's why in our case at least, we believe that PMS would be a better vehicle for a alpha generation for an investor rather than AIF. Not that we're not going to launch an AIF, we'll be launching that also later. But just to put things in perspective, that's how we felt.
Kenneth, your last comments.
Hmm. Well, I worked across both the platforms, all three platforms. We have an AIF, we got a PMS, and we used to do the same thing at IDFC. So I haven't really found any differences. It's just your investment approach. The rest is all a vehicular route to the marketplace. I think our core portfolio used to hold about 30% in IDFC. Today we have between 20 to 24 companies in our PMS and the AIS. So I think that's the structure. I particularly don't think that there is too much of a difference managing money in either of these formats. Yes, after a particular size, you will dilute returns, because over a period of time, if the portfolio does get beyond a particular point, for a fact, mutual funds have diluted concentration risk or over diversified the portfolios, which is why returns are now tracking benchmarks. But I think if you have an investment approach which is consistent to what's delivered the alpha in the past, and either of the vehicles would work for you.
Completely agree with that. I think with that we'll wrap up. I just want to thank Kenneth for his always very insightful and thoughtful answers, very honest in his there. We wish Dinshaw and Helios Capital very, very great success in India. And it's always a pleasure to listen to the optimistic and ever optimistic Sunil Singhania, who sets the tone. But I think one of the things which he rightly said, I would like to end for the viewers, that please rationalize, given where the fixed income rates are there, we need to rationalize our expectations, whether it is a PMS or AIF platform, in about 9-10%. That's what you said, Sunil, right? I think that would be the perfect place one should look forward for there. Thank you so much, gentlemen. Always a pleasure to hear
Thank
you.
you.
Over to you.
Thank you.
Yeah, thank you.
Thank you very much,
Thank you.
gentlemen. And I think there were a lot of wonderful insights that you've all shared today with us. So thank you so much. And I think rationalization in life in general sort of sets us on the right path. And especially during a time like this when everything is a little uncertain, I think rationalization is definitely to the way to go about it, not just in finance, but in life as well. So thank you so much, gentlemen, for joining us today. It's been an absolute pleasure listening to you share your valuable insights with us. Once again, on behalf of the entire committee, a very big thank you to each and every one of you.
Thank you.